The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Michael Sidgmore is a partner at Broadhaven, a market-leading fintech investment bank and venture firm, with clients including ICE and the CBOE, and investments including MoneyLion and ScaleFactor. Prior to joining Broadhaven, Michael built the sales team at iCapital, now a multi-billion-dollar platform giving investors access to leading alternative investment funds at low minimums. Michael is close to the ground when it comes to U.S. fintech, with an interest in Latin America as well. In this conversation, Michael shares his views on SME plays, opportunities in Latin America, platform trends, solutions for the gig economy, and more. Thank you very much for joining us today. Please welcome Michael Sidgmore. Michael Sidgmore, welcome to Rebank.
Thanks for having me, Will.
All right, so for context and to kick things off, quick intro to you and to Broadhaven.
Yeah, so I'm a partner at Broadhaven Ventures. We are a early stage fintech VC, mainly focused on seed stage, do some Series A. Have 14 early stage fintech companies in our portfolio that we've built out over the last 2.5 years. And as a group of 5 partners, we actually have a prior portfolio of about 20 other early stage companies. So we've made about 34 early stage fintech investments. Really try to help out very early on, having all been ex-operators. I built the sales teams at iCapital Network with 2 others pre-product and at Mosaic, where I was the first sales hire. So I've been very early, as have all my partners, either building businesses, building sales teams, et cetera. So just try to really be helpful early on, get companies their first customers, help them hire teams, help them build out their business strategy so that they can get Series A. And we really are able to leverage another business that we have at Broadhaven, which is Broadhaven Capital Partners, a market-leading fintech investment bank and advisory firm that was started in 2010 by the former head of fintech M&A at Goldman and his partner, who's an executive at R.J. O'Brien. And what they've done is they've built out a great platform at the top end of the market, working with large financial institutions and fintech companies, either advising them on M&A or large capital raises. So we're really, as early stage venture fund, able to leverage that network of large financial institutions that we know. We have 12 partners on the advisory side of our business, and that really helps our early stage companies. Okay, so it's kind of seed stage venture on the one hand, and then it's kind of later stage, growth stage, probably M&A type investment. Much later stage. Okay. And they're really 2 separate businesses. So we run the venture business as kind of the mindset of how do we invest in great companies and great teams and founders and help them grow their business. And we can leverage the platform that we have on the investment banking side to supplement and help them build their business in whatever way is helpful, whether it's introductions to customers, whether it's understanding markets, business models, helping them with strategy. If they need to raise capital, we've helped some of our lending businesses actually raise large credit facilities as a result of the network and connections we have. So we're just really able to help out our fintech businesses, which I think in a highly regulated industry like financial services can end up really being helpful, and especially at the early stages when it can be so hard to either navigate a heavily regulated landscape, an incumbent landscape with a lot of big banks getting involved in fintech financial services, and just opening doors. I mean, at an early stage, it can be hard to open doors if you're an enterprise fintech business trying to sell into large banks, and if we can help them do that, then that's something we really try to help out with. So on the M&A and investment banking side, are you working mostly with kind of late stage startups, or is it more with incumbents? It's more with incumbents. We've worked with ICE, we've worked with CBOE, we've worked with BATS, we've sold businesses to Thomson Reuters. We've done large private placements for companies like Symphony, messaging platform for capital markets. We've raised a large amount of capital for R3, the blockchain consortium, by a bunch of banks. So that's really a business at the top end of the market. Mm-hmm. And then we operate on the early stage venture side at the total other end of the market, really helping seed stage and Series A stage fintech companies help them build their business. Yeah.
Any noteworthy early stage investments you guys have made?
Yeah, so we've had the good fortune of investing in some fintech businesses that I think have built great brands and names for themselves, and we've just tried to be part of that journey. So we were early investors in MoneyLion, we were early investors in Carta, we were early investors, seed investors in ScaleFactor, which is an automated accounting platform for SMBs that raised a $10 million Series A from Canaan Partners and a $30 million Series B from Bessemer within 6 months of each other. We were seed investors in Credit Justo, a Mexican SMB lender that's gone on to raise $10 million from QED and Kazakh in a Series A and has a $100 million credit facility from Goldman. We were early investors, seed investors in Trizic, which is a automated digital advice platform, almost like think of like a end-to-end digital advice platform for banks and credit unions. So robo, but white label in a sense, that raised the $10 million Series A from Sorensen Capital and FIS, the core banking tech provider. And we have a number of other earlier stage businesses that we've made recent investments in that we hope will make a name for themselves quite soon. And we think they're on a pretty good track to do so.
Nice. So you mentioned SMB. What I guess in the UK they would call SME, so small and medium-sized businesses, and you know it's a theme near and dear to my heart, having started a bank in that space, and it's interesting to see kind of this evolution from digitally recreating traditional products, often on a kind of standalone basis, often leading with credit, to a kind of new wave of innovation. It feels like, which is more around kind of automation across middle and back office type functions. And I think you mentioned ScaleFactor in there.
Yep.
I guess maybe using that as an entry point. What are you seeing in that space, and what are you excited about?
Yeah, the SMB space is fascinating. We have a theme at Broadhaven that we call "quote unquote" banking the SMB. What that means to us is there's a whole suite of financial products that could be provided to the SMB that can help them build and grow their business. It could be loans, it could be products, corporate card products, et cetera, that are being built for the SMB to help them build and grow their business. There's also a suite of software technology tools that can help them streamline or automate their financial operations. So we look at the kind of SMB and think about the finance function. How do we help firms automate that? ScaleFactor is a perfect example of that. So what they've built a platform to kind of basically be the business operating system for the small business. So in the US, small business owners are kind of using between 10 to 14 different software solutions for their financial operations, everything from, QuickBooks and Xero for their accounting software, to payroll providers like Gusto, to, bill pay like Bill.com, expense management solutions like Expensify. And they're constantly using all these different softwares, but what if there was a way to integrate all that into one platform, really have a command and control center for the SMB? So it either helps and streamlines the finance function for the employees who are working in it, or some SMB owners are the ones doing it themselves, and they might be running a yoga studio and they want to teach yoga. They don't want to have to, worry about their financial operations. They would rather have a platform that can do it for them. So ScaleFactor has created a platform that integrates with all the suite of financial operations tools and provides that business OS. And then I think when you think about kind of really understanding and owning the data of the guts of the business, the cash flows, helping them predict out and forecast how they should continue to run their business, whether it's, do they need more capital? Do they need to hire? How do they think about their own burn rate? You can really help them and be kind of their co-pilot in that process. So that's what ScaleFactor's done. I think it's a really, really important tool to have, because when you look at some of the statistics, 50% of all small businesses in the US go out of business within 5 years, and it's due to lack of cash flow visibility. So they're not able to manage their finances properly, therefore they go out of business, and ScaleFactor really solves that.
Mm-hmm. I think there was another SME-focused business that you mentioned, whose name I'll probably butcher, Credit Justo, I think it's pronounced.
Perfect.
not a Spanish speaker, but and they're basically lending to small and medium-sized businesses in Mexico, right? Mm-hmm. Which is probably a relevant theme to pick up. I know you personally spend a lot of time looking at kind of Mexico City, and I think you're pretty excited about it.
Yeah, I'm really excited about the Latam market broadly, and in particular Mexico. So I was actually one of the first investors in Credit Justo back in 2015. We then co-led an institutional seed round in 2017 with Elevar Equity, and I joined the board of Credit Justo. I think when you look at the Mexican market in particular, there's a lot of things to get excited about, both on the consumer side of fintech and certainly on the SMB side. So you look at some statistics. It's a huge country, 129 or so million people. Mexico City alone has 20 million people. That in and of itself is a massive market. You then look at kind of some of the fundamentals of the kind of financial services ecosystem. There's significant underpenetration of credit, particularly for small businesses. So banks in Mexico really don't have to bank many of the SMEs. 99% of all businesses in Mexico, 5 million businesses, are small businesses. So there's a large portion of the business population that's not being banked. And if they are being banked, it's taking them 2 to 3 months to be underwritten. So a business like Credit Justo comes in and uses technology to create a much quicker and faster underwriting process, but they're able to do so because they have a technology platform that captures a lot of data on a small business. So there are some really interesting features about that market. For example, the Mexican equivalent of the IRS tax system, there's APIs to plug into that. So Credit Justo is able to capture those APIs and plug into that and actually get data on the small business to help underwrite them. And therefore, they're able to underwrite small businesses in days rather than months. And it provides this access to capital, which I think makes for a really interesting business platform to then kind of think about how do you serve the small business. And they've done a great job providing term loans to small businesses. They just got a $100 million US credit facility from Goldman Sachs as a result of the progress they've made. And they are one of the market leaders in terms of the SMB lending space in Mexico. And I think there's really a greenfield opportunity kind of as a result, just because many of these businesses are underbanked.
Yeah. So you and I were at a Propel event the other day, and there were a bunch of BBVA executives there. They obviously have a strong presence throughout Latin America. And there were a few side conversations with people around, interest in Mexico City and people kind of starting to tune into that. Mm-hmm. What's your sense of just the kind of the broader VC investor interest from, say, Silicon Valley into a market like Mexico?
Yeah, I think Silicon Valley is starting to think about Mexico and Latam. Brazil has a relatively well-known presence kind of from the Silicon Valley VCs, and they've invested in fintech companies there. Nubank, it's a Brazilian digital bank. David's been on your podcast. They're a $4 billion business. So I think people recognize that and say, oh, wow, there's really interesting platform businesses to build in places like in Latam, places like Brazil and Mexico. I think if you asked me this question in 2015, 2016, I would say still relatively undiscovered. I think if you ask me this question now, and I do spend a decent amount of time on the ground in Mexico City, building relationships with VCs down there, founders, just being in the ecosystem, I think it's no longer a secret. And I think we're at that inflection point of just due to so many different forces, a combination of you have interesting fintech solutions, you have great entrepreneurs building businesses in Mexico and good talent there. You also have companies that are maturing. So Clip, for example, is kind of like Square for Mexico. They raised $45 million from General Atlantic. And if you think about increasing credit card penetration from kind of sub 20% like it is, a mobile point of sale system can help do that. And I think you're right at that inflection point. So people are taking notice, in a place like Mexico where there's a massive market, 50% cash economy, 50% unbanked, sub 20% credit card penetration, but 80+% mobile phone penetration. So some really interesting market dynamics there. Again, like I said, both on the consumer and the SMB side. As a result, I think Silicon Valley VCs are interested. You're also seeing growth funds and private equity funds really participate in the LATAM and Mexican market in particular. So Temasek, which is a large sovereign wealth fund from Asia, they have a VC fund focused particularly on the Mexican market and LATAM more broadly. TPG Growth, they have what's called the Rise Fund that's focused on emerging markets with a big focus in LATAM, and they're in Mexico for sure. General Atlantic's made investments in Mexico. SoftBank just announced a $5 billion fund focused on LATAM. So because of those things happening, I think now Silicon Valley VCs are actually starting to realize that this is a really interesting place to look, and I think you'll start to see them come down more. Two other interesting things. One is it's easier to get from San Francisco to Mexico City, 4-hour flight, than it is to get from San Francisco to New York, 5-hour flight. So that's one thing. And I think the other piece of it too is, it's just, you can build a great business anywhere. You can also do it at a much lower burn rate in a place like Mexico. So $10 million US dollars is $10 million US dollars. Yes, you have to be cognizant of exchange rate risk. Yes, there's questions as to what the exit environment looks like. Will there be as many IPOs? There's only been $250 million US dollars of equity investment, VC investment into the Mexican Fintech ecosystem. That will certainly increase I think that was as of kind of end of last year. So that number will change this year as a result of some large financings. But I think you're right at the beginning of a real inflection point for Mexican fintech.
So if you're a Silicon Valley VC or any investor from a developed market, how do you develop the nuance to appreciate the local conditions in a market like Mexico and not try to kind of replicate what you've already seen, what worked in the Bay Area, expecting that it's going to work in a new market?
Well, so it's interesting. I think when you look at any greenfield market, so to hit on your last point first, when you look at any market with kind of greenfield opportunity, I think what we're seeing in a place like Mexico, as opposed to the US, which is people are creating highly verticalized fintech solutions, and they have to be specialized because they have to have a wedge into a market and then expand horizontally, particularly on the consumer side, right? So it's like they have to start with a debit card product and then expand into other aspects of people's financial lives. I think when we look at a lot of consumer plays in Mexico, what we're seeing is that people are combining or can combine 2 or 3 different aspects of what might be 2 or 3 different businesses here in the US, just because there's more of a greenfield opportunity. So I think what it means is there's the ability to really build platform businesses, and you can start in one place and end up expanding horizontally and really owning a market by being a brand. That is really appealing, and I think that means you can build really big businesses. Nubank is a perfect example of that. They did that in Brazil. They're now moving into Mexico. I think there's also really interesting things when you think about different cohorts of people. So there could be companies focused on the gig economy space, for example. So it could be doing things like providing cars to Uber drivers. Think about ways in which you could then penetrate their financial life, and you can own that relationship with the customer in ways you may not be able to in the US. So I think that's kind of the first point there. To the second point about, how do you, as a non-local VC, how do you spend time there? I think one is it's important to spend time on the ground. From being on the board at Credit Justo since 2017, I've made a conscious effort to really spend time on the ground. And it's important because you need to understand the local ecosystem, who the local VCs are and are finding companies early, and the local system of talent. I mean, there's some really great talent in Mexico and Latam more broadly, but there are people coming out of, companies like Mercado Libre or Linio, which are e-commerce plays, and they're then looking to start businesses. And it's important to spend time on the ground to really get to know those people and really then be able to help your companies from a talent perspective. The other thing for us that we try to do as non-local investors is build really strong relationships with local market VCs so that we can then partner together and they may be on the ground. So I think that's another big piece of this is we try to really build relationships with other investors, and then we feel we can complement some of the work they do, and hopefully they feel we can complement some of the work that we're able to do with them.
There were 2 points that you kind of touched on there, both of which I want to pick up, maybe sequentially. One was around gig economy, and one was around brands becoming fintechs.
Yep.
Maybe we start with the latter.
Yep.
Brands becoming fintechs. We've had Brad Goodall from Banked on the podcast before, which is it's effectively an open banking play, but it's really geared toward helping non-bank, kind of non-financial services organizations unlock some of the data that currently resides within banks. And we're certainly seeing it as purpose-built infrastructure platforms look to kind of surface data in new, easy-to-consume ways, either because you're a back-end bank and you hold the licenses and you raise the capital and you're providing kind of API-based account opening or deposit lending services to fintechs, or potentially because you're offering white label solutions to a telecom provider or an Uber or Lyft.
Yeah, it's a fascinating time for fintech in that regard. I think for a number of reasons, people see the ability to own the customer and brands who are at the center of a transaction. Potentially, they could be at the point of sale of a payment. They could have a really good brand as an e-commerce brand that a bank doesn't have. And I think, to be honest, part of this is post-global financial crisis. Millennials don't necessarily trust banks as much. They operate much of their lives on mobile phones. They like certain brands and maybe don't associate banks with those types of brands. So I think a lot of companies see the opportunity to build that customer acquisition engine that can provide a great experience, great brand, and therefore they can own the customer in that way because they already own them in another way. What that means for other aspects of fintech is that if you can build the infrastructure to power that to happen, you will be able to enable brands to do that. Lyft, for example, they just announced that they are launching a driver financial services program. That means having a bank account. They've partnered with a back-end bank to do so. They are not going to be the bank. Maybe at some point they will, but they may not also want to be the one that has to be regulated like a bank. So they can partner with a bank to do that. They can provide the kind of customer experience for their constituents that they want, and do so. And I think the trend of brands becoming fintechs is something we will continue to see, but we will continue to see it because the kind of fintech ecosystem as it has been built out over the past few years is enabling that to happen. So companies like Plaid have enabled companies to figure out how to get accounts or get insight into people's bank accounts. And that's enabled, companies like Betterment and Wealthfront to be created. You're looking at companies like Synapsify, which provides kind of API infrastructure for people to do everything from open bank accounts to issue cards, whether it's, on the consumer side or on the corporate side. You're seeing companies that are providing the infrastructure layer to allow the brands who do deal directly with the customers to own those customers and provide a good experience, while then partnering with a bank on the back end or a technology provider that then works with a bank on the back end to do it. And I think that's something that we're going to just continue to see more of, where kind of transaction banking and kind of this idea of commoditizing the back end so that people can just build whatever front end they want will be interesting. And then what that'll mean for the front end is that whoever acquires customers best will be the ones who win. I also think that we'll see a lot of companies on the consumer side really not make it. So what that also then means is then, okay, well, so if there's a lot of consumer fintechs going after the same market and same customer, how should an investor think about that? And I think what that means is, if you're on the consumer side, you're probably going to have to find ways to spend a lot of money to acquire customers, which means raising a lot of money and being very capital intensive. Personally, from my perspective, when I think about brands becoming fintechs, I like the infrastructure side of it. So how do you provide the picks and shovels to people who are actually going out and digging for gold? In that case, being customers. Yeah.
Well, I mean, I think it's a fascinating dynamic in the UK and Europe. Everyone's excited about open banking and what that potentially means. Obviously, it's a kind of a legislative mandate. In the US, effectively, we're seeing the same sorts of developments, but led by more innovative companies.
Yes and no. So I'd say the regulatory landscape in Europe and the UK has actually been very advanced, and it's enabled digital banks like Monzo or Tandem, Atom and Starling to be created. Companies like N26 in Europe are incredibly innovative. And I think what's interesting is you've seen them innovate in Europe, UK, and now companies like Monzo, Revolut are actually going to come to the US and try to build digital banks here. Now, I think it's in some ways harder to build digital banks in the US for a few reasons. One is you have it's a slightly different regulatory system, very capital intensive, and a lot of hurdles on the regulatory side that you don't have. There have been some companies like Vero. I believe you had Colin from Vero on the podcast, but they've chosen the route of getting a banking license right away. They've also had to raise a lot of money to do so from the start. That's a very different business than starting out as kind of a, either some sort of a mobile wallet or, a debit card, credit card, or even a payroll advance business that, is trying to capture the customer in one specific vertical and then maybe expand horizontally. And I think, it's interesting to see the evolution of digital banking in the US, where you have a lot of non-banks. So companies like MoneyLion or SoFi, they are not quite banks, but they're providing a lot of the services that may seem similar. Think about, savings, wealth management, lending, mortgages in the case of SoFi. It's a slightly different market than a place like Europe. So it'll be interesting to see as entrants come in what that means. I also think what that means is there are companies that will be successful creating kind of broad-based consumer finance platforms that will build big brands. SoFi's done a good job of that. MoneyLion's done a good job of that. I think they've been successful because they've focused on a cohort. SoFi focused on the Henrys. high earners, not rich yet. And they follow them through their financial life, and they've been able to provide products to them at different points in their financial life. But they were able to be successful not because they said we're going to build a digital bank for everybody. They were successful because we said we are going to serve this customer cohort and follow them through the journey of their financial life. And I think that's in the US probably the right way to go about thinking about it. It's hard because you have to become that brand for that cohort. But if you do it and do it well, I think it can be very good business to build.
Yeah. So looping back to the gig economy piece, I know you've looked at a few things there. We've had companies on the podcast in the past, like Zego in the UK, which is insurance for flexible insurance for gig workers. Mm-hmm. Yeah, there are companies now thinking about how to make mortgage loans to gig workers, make unsecured consumer loans to gig workers, support investments and retirement savings for gig workers. And I think, actually, there's some interesting concepts too, and maybe it's a slightly unrelated topic, but around working with employers to help deliver kind of as a payroll benefit or an HR benefit some of the same financial services that traditionally would have been originated directly to customers.
Yeah, so the gig economy is a really interesting space for financial services. So we at Broadhaven, we think about kind of the provision of financial services to the gig worker. And I think gig worker means different things to different people. You look at kind of 1099 worker writ large. That could be gig worker, i.e. Uber or Lyft driver. There are also, 90 some odd other gig companies, or platform companies. So like Bellhop's Moving, for example, it's where people, are on-demand movers effectively. So, there's DoorDash, there's Instacart, et cetera. So there's a number of other companies in the gig space. There's also freelancers. So those are people who are 1099s, meaning they're not a W-2 employee who are, don't have employee benefits as a result. So it's a very large space. There's almost, 60 some odd million gig workers of some sort in the US. There's another kind of 70 to 90 million in the EU. So massive markets. And I think what that kind of, if we rewind the tape, this is really indicative of just kind of a whole confluence of things around the employee-employer relationship. What used to be the social contract of employer provides benefits and kind of a whole set of things to the employee who therefore stays at this company for 20, 30 years. They get 401ks, they get healthcare benefits. They are taken care of by the employer. That no longer is the case, I think, for a few reasons. One is you have people who want much more flexible working lives. You have younger people who may move different jobs every 2, 3, 4 years. That's just the way that they think about the world. And what that means for employers is they don't want to manage all these orphaned 401k accounts for employees who are no longer there. That's not good for their business. It's not good for their margin. So for those reasons, and then you have, just the statistics around Americans kind of with savings and kind of hitting walls with financial emergencies. So 63% of Americans, if they were hit by an unexpected $400 expense, would be in financial emergencies. So people may need supplemental ways to generate income on demand or quickly. So for a whole number of reasons, I think you're seeing people move to the gig economy, whether it's they want to do that as their full-time job effectively and have flexibility and maybe work 2 or 3 different gig jobs. They may drive for Lyft or Uber. They may also deliver food for DoorDash or Postmates, or they may be grocery shoppers for Instacart. And they just want more flexibility in their lives. They might be trying to do another career at the same time. And then you have people generally actually kind of 50s and older who don't have a ton saved for retirement, and they need things like savings for healthcare expenses later down the line, or they just need to save money for retirement. And this is the way for them to build income to do that. So we look at this as like, how do you provide this whole suite of financial services across their financial life, whether it's help them build income, save money, whether it's get healthcare expenses covered through healthcare benefits of some sort, or even things like health savings accounts. So we've actually invested in a few companies in this space. 3 of our last 4 investments have actually been in the gig economy space, and 2 here and 1 in Latin America, focused on the gig worker and providing financial services to them so they can build income, have healthcare benefits covered and expenses covered, so that they can live a stable financial life.
There is so much going on in this space, and you bring a massive amount of energy to it. It's fun to connect, and we should probably do it again at some point in the future and update.
Yeah, would love to. Thanks a lot for having me on, Will.
Yeah, Michael Sidgmore, thank you very much for joining us today.
Thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.